So should you still be looking across the globe or just stay with the U.S. trade? Paul Christopher is the head of global investment strategy at Wells Fargo Investment Institute. And also here with us is Brendan Ahern, the CIO of KraneShares. They manage a very large China-based ETF. Paul and Brendan, thank you very much for joining us here. I'd like to maybe start with the global picture, Paul, before we drill down a little bit more into the Asian side of things specifically. Is the U.S. versus the rest of the world trade clear to you? And if so, where is the capital going to flow to?
Yeah, we think it is still clear. There are some cross currents out there, but they really don't have anything to do with U.S. exceptionalism. One pattern is that there was a lot of overbuying of tech at the end of 24, and that has reversed in the first 3 months of 2025. That doesn't have anything to do with tariffs. A second piece of it was that European banks did really, really well in the first part of the year, but now the downgrades are leading the upgrades by quite a large margin, and that outperformance is starting to slide. So we think that, if you're looking for quality here and in a world of uncertain policy, we would still stay with the U.S. and we would buy what has good long-term trends and that has good balance sheets. And that starts with IT, information technology, consumer discretion, comm services, communication services, and there's a couple of others. But we would stay with the U.S. and a quality focus.
All right. Brendan, I hope it goes without saying for many of our audience out there that diversification has always been one of the strengths of portfolios, no matter what. You have to be diversified. It's not like we're just placing bets just on the U.S. or just on Europe or just on China. What exactly then does it look like allocation-wise if people are looking for opportunities in China, a market that has been shunned now by many investors across the Western Hemisphere?
Yeah, definitely, Dom. I think, the U.S. accounts for 2/3 of global equity market capitalization after a 16-year bull market, driven also by a very strong U.S. dollar. And I don't think all of those tailwinds end for U.S. equities. I think simply you're seeing a little bit of a global rebalance taking place. I think outside of the U.S., institutions are starting to rebalance maybe a little bit back into some of these non-U.S. equity markets that have really underperformed over the last 16 years. And we definitely think that Chinese tech companies on a relative and an absolute basis are very inexpensive. And obviously that's self-serving and highly biased. But we think as we go into Q1 earnings season with Alibaba and others reporting just next week, we think there's potentially a really strong catalyst at hand.